Hi students, hope you all are doing well. Welcome to another session of healthcare entrepreneurship. So today we are going to pick it up from where we left last time. So let's get started. So even though the quantum of money is generally not large, that's what I was mentioning, it is usually enough at the idea stage. So at the idea stage, if you have a few lakhs of rupees at your disposal, it is great, right? I can build my prototype very conveniently and I can start showcasing, probably spend a little bit into the flyers or marketing brochures and things like that, right? So what makes the difference at this events is having a very good business plan. So I'm going to explain about business plans, like in the coming lectures, where how you can have a nice business proposal or a product proposal or a business plan, right, which can be helpful in raising money in these kind of events and also for pitching to several early stage angel investors. Next part with the fundraising is validation. At this stage, a startup has a prototype ready and needs to validate the potential demand of the startup's product and service. So this is typically what I have explained as the extension of the customer discovery. Once you have a MVP or a prototype ready, you start showcasing that to customers, and this is typically when you have something which is known as a proof of concept. After this proof of concept, you will probably end up having this big market launch. So at this seed stage, basically what you are looking at, a startup will need to conduct field trials, test the products on a few potential customers, onboard mentors and build a formal team for which it will explore the following funding sources. First is incubators. So typically at the validation stage, while you have a prototype and you are trying to understand the prototype by conducting a proof of concept or set of tests, this is the time at which you will be typically reaching out to some of the incubators. So if there was a question in your mind, what is the right time to reach out to an incubator? This is the right time when you have started building your prototype, right? Incubators by definition are organizations set up with the specific goal of assisting entrepreneurs with building and launching their startups. Not only do incubators offer a lot of value added services like office space, utilities, sometimes the address of the registered company. So a lot of things you will get, admin and legal assistance. So many of these incubators have like people, folks from the industry to file for patents. They have nice legal assistance team. Of course this comes at a with a certain amount of fee which you pay for all these services when you incubate, and it gives you a nice working space, in certain cases co-working spaces, certain utilities like stationaries and things like that, maybe a nice place to sit, which you may not be able to establish by your own with the initial given amount of funds, which may not be too much, right? So you want to incubate. Incubators are typically by the terminology, what their focus towards is making sure at the startup stage they can handhold you towards the different aspects, unless you become an independent company or independent startup where you are very confident that you go out in the market, you can have your own space, have your own team, do everything by your own. So it's a kind of a stopgap arrangement or a transition step between having to be an entrepreneur, where we are all are kind of discussing whether we want to be an entrepreneur, and the next thing is we have this great idea, probably a great prototype, and we want to make sure that we can start a company. So rather than just diving and starting your company fully, like, and possibly incurring a lot of losses if we have not planned well, this incubation phase, which is typically between a year or 5 years, gives you a nice hand holding with all the resources which are provided. You have quite a few very good mentors from the industry who are experts with startups and businesses, who will give you right mentorship and advice, like, probably the marketing technique which you're following is not right, or you're going way too early in the market. So a lot of these advice, or probably you should not fundraise at this point, fundraise in 6 months, or two things like this. So these kind of things can be accumulated, right? All this knowledge, right? So the government loan schemes is another thing which you would typically look at during this validation stage. So the government has initiated a few loan schemes to provide collateral free debt to aspiring entrepreneurs and help them gain access to low capital, such as Startup India Seed Fund Scheme and SIDBI Funds of Funds. A list of government schemes can be found. right, like with certain links. Just look up startup government schemes, like you will see there is a Startup India web page and you will see a lot of these schemes, right. So the government of India has very kindly, like looked at the startup scenario and acknowledged that India currently is so eager to start up, right, like, and they have created several loan schemes which do not require any collateral, because a lot of the startups are really scared, like, to venture out and start up. India is still going through that transition where we are not so well versed with the risk taking ability, right, like a lot of these western countries have already learned how to take the risk and start companies, but we are still in that zone that we are kind of making that transition, that do we want to take this much amount of risk or fall for something where we have a secured job or secured payment and maybe start up. These kind of things are still going on. So that's why the government is encouraging a lot of the companies to start up, specifically in the healthcare segment, right. So you can get a lot of collateral free loans for just through applying, and validation or prototype ready stage is usually the stage at which you will go for these, right. Okay. Yeah. So the next part is in the validation. At this stage, a startup also would look for angel investors. So during this validation stage, so angel investors are typically individuals who invest their money in high potential startups in return for equity. So angel investors are not giving you funds for nothing, right. So what you see in Shark Tank or something similar is they are majorly angel investors or VCs, right. So you would typically want to reach out to the angel networks such as Indian Angel Network, Mumbai Angels, Lead Angels, Chennai Angels. So there are a lot of angel investor networks which has a lot of angel investors. They are majorly people who are extremely successful with their businesses, and there are certain people who are just interested in, placing their bets or placing their money in like, let's say 50 startups, right. So this particular person may want to, they are so successful, they have, like, let's say 50 crores of rupees at their disposal. They want to place 1 crore for certain equity in 50 startups, for example. So these are kind of angel investors. And there could be people who are looking at potential thematic areas in which, like ed tech or health tech or things like that, which so you have to specifically look at who is interested in what kind of funds, right. So there could be angel investors who are not interested in certain medical devices because they just don't want to get into it, or all the regulations or regulatory aspects. So that you have to clearly see that what are the kind of angel investors who are out there to like who are interested to fund the product which you are trying to build. So the last one is crowdfunding, which crowdfunding refers to raising money from a large number of people, which I have just explained, out of which each contribute a relatively small amount, right. So in India, typically you would see crowdfunding not for products or like a lot of startup ventures, because of several issues like which may come up, like there could be frauds or there could be things where products are not very nicely presented and things like that, like many a times the companies have not registered, and laws and regulations with the crowdfunding is still, like, under consideration in several places. But you would see typically crowdfunding in terms of, like, when there are some natural calamities, right. Then through Facebook and so many other places, people are all funding or placing like their 500 rupees or 1000 rupees or whichever amount of funds they can do to help some natural cause, right. So crowdfunding can be thought about in a very similar platform. When you are trying to really boost up the enthusiasm of a certain startup which seems to be very, very unique, let's say somebody is looking at some neural health or some kind of like mental health, which is a very, very innovative startup, and they're trying to people from all across are trying to put their little bit of money to buy the first product or first set of services for the startup. So that is how crowdfunding is typically done. So these are done using online crowdfunding platforms. Many of these platforms are still not very popular or properly regulated in the country. right? So they have to be looked upon or taken with caution. But crowdfunding in the US or other places like Europe is very popular, right? So we will get back to crowdfunding as we go along. The third segment of a startup is early traction. At the early traction stage, startups products or services have been launched in the market. So right now we are in the commercialization module. We are talking about products which are just ready to get into the market and the ones which have been launched, right? So the key performance indicators are customer base, revenue, app downloads, etc. Right? So you want to make sure if a product is launched, it has its huge hype around the kind of revenue which it is generating. Let's say there is an app which has gone viral or things like that. So from a funding standpoint, what the funding agency or the funders are looking at is, after this company's launch, how are they doing? How have they done in the last 3 months? How have they done in the last 4 quarters, or how have they done in the last 2 years? Things like that are usually looked upon, right? So this is where you are looking at the Series A stage funding, okay, early traction. So funds are raised at this stage to further grow the user base, product offerings, expand to new geographies, etc. Common funding sources utilized by startups in this stage are venture capitalists, NBFCs and venture debt funds. I will explain all of these. This is typically when you have started commercializing. Let us say you are a huge hit in the Delhi region, you want to explore it, now expand your business to the southern part of India, or you have been a huge hit in India and you want to expand your business further outside India to the APAC region, right, or somewhere else to the US and whatnot, right. So here you are looking at Series A stage funding, and Series A stage is not a single application or something per se, it's a canvas term. So you are basically looking at venture capital funds at this stage, where VCs funds are professionally managed by investment funds that invest exclusively in high growth startups. So a lot of these VCs are in form of companies which just invest in other smaller companies where they think that the growth potential is massive. Each VC has its own investment thesis. They have their preferred sectors, stage of startup and funding amount, right. So if you are trying to look at seek funding in financial sector, it's very different. If you are trying to seek funding in the healthcare sector, it's very different. Not all VCs are targeted towards healthcare sector. They may not want to fund, right. Certain VCs may be targeted towards some form of non-medical device kind of products, so pharmaceutical drugs, right. So they can be, or surgical instruments, right. So each VC has a preferred sector, the stage of the startup which they are trying to fund, and the funding amount which they are about to put, right. So there could be certain VCs which are willing to place like 10 crore plus of rupees, and there could be certain VCs who are just interested in placing something around like 50 lakh of rupees. You will get to know once you are in this startup mode and you are exploring who are the VCs, you will know who is who, and then basically how much they are trying to offer, right, which should align with your startup typically. So the VC is not going to give you funds exorbitantly or give peanuts amount of funds which you need. They will understand, they are very smart agencies, they have developed, they are into the business, and they would understand whether your startup is going to possibly make them enough profit or not, right. VCs take startup equity in return for their investment, this is very clear, and actively engage in mentorship of their investee startups, right. So is VC fund a good thing to seek? This may be a question across a lot of us. Yes and no, it depends, like which stage of your startup. Let's say you are in the early traction, you may need a VC fund or you may not need a VC fund. You have to understand that if I take a huge amount of capital, let's say 50 crore or 200 crore or something like that, if we are trying to raise from a VC, then typically a good portion of that company is taken up by the VC, who will completely influence the decision making and things like that. In future, your company may have a completely different direction as per the VC's interest or where they think like the profits will come from, and it may dilute your initial motivation or passion for your company or product, right. So, you have to be cautious before enrolling for VC funds. So many of the Indian startup companies, if you see, and we are still at the infancy with that, uh, are trying to shoot for VC funds, like have you got the Series A fund, have you got the Series B, but many a times they are not focused on sustainably developing their product or having an organic conversion of their commercialization, where there are organic customers. Sometimes they will raise a huge amount of fund, and after 2 or 3 years they do not have too much sales and their company completely drowns, right, or gets bankrupt. This is very commonly seen with a lot of companies, right. So, in order to avoid that, you have to kind of smartly think about whether I need a VC fund at this stage or probably at a later stage when you are very confident that this VC will add some value. Maybe you want to grow in the West, right? So, then probably it will take care of your funds or to set up the facility in the West and things like that, right? But do not always go for seeking VC fund at the very beginning, or consider it as a metric of your success of your company. Your startup or product is not successful based on the amount of funds which you have raised from the VC. It will be successful if it has delivered what it promised to the customers and the customers are able to pay for it. That is the organic conversion. Just raising funding a huge amount is not going to be your success, right. So, this is a point to be noted as we speak into the different fundraising avenues, right. The next type of avenue is banks or non-banking financial companies, like which are typically known as the NBFCs. Formal debt can be raised from the banks and NBFCs at this stage, as the startup can show market traction and revenue to validate its ability to finance interest payment obligations. So, these banks and non-banking financial companies, which are known as NBFCs, will typically look at the balance sheets of your company, how you had been doing in terms of revenue or profits, and based on that, if they think that you have matured as a company, that you are able to generate some revenue and you are not solely dependent on the funding, whereas you will be very surprised to hear majority of the companies would be solely dependent on funds. They would think, let that 5 or 10 crore rupees come, then only I can start up, and majority of this would fail, right. So, these companies are very smart in looking whether this startup which is seeking funding is ready to or is able to generate a good amount of revenue, which assures them that you will be able to repay their funds or interest amount, whatever their installments are, on a monthly basis or a yearly basis, right. This is especially applicable for working capital. Some entrepreneurs may prefer debt over equity, as debt financing does not dilute equity stake. So, this is the difference between debt and equity. Equity is where somebody is taking a huge amount of stake for a massive amount of funding which they can provide. Debt funding is usually you will be given a conservative amount of funds, like, and but you can basically you don't have to worry about, like, diluting your stake, or the bank is not trying to take a 30% of your company or 3% of your company even. They are basically trying to make sure you can pay the installments. So, the repercussions or the final goals are very different, right. Next is venture debt funds. So, venture debt funds are private investment funds that invest money in startups primarily in form of debt. Debt funds typically invest along with angel and VC round. So, many a times, many of these venture capitalist funds may give you something in form of equity. So, they may give you, let us say, 10 crores for 10% of your company and give you further loan of 5 crores with a certain payment option, right. So, sometimes mix of different equity and debt financing techniques are used to facilitate or give you the right amount of funding, right. So, it is not always that you are raising equity funds or always that you are taking loans or raising a debt fund. Sometimes it could be a mix of both, which you are trying to seek as a company or as a entrepreneur. Further things with the early traction. So, Series A stage is typically used for Further growing of the user base, product offerings into new geographies. This is something we have already explained. I have highlighted the 3 types of funds which come under the Series A stage. These are some examples, right? Top Series A funding in Indian startups, this is still 2021, right? So, this is not the latest, but some of the key ones which you can look at are like Ola Electric. This was very popular. This raised a lot of Series A funding, right? What is the amount you are looking at? $58 million, not a small amount of fund, massive, most likely through some form of equity and could be some form of debt financing in addition, right. Mensa Brands, Design Cafe, Cred. A lot of us know what Cred is, right. Cred is like that where you have like one wallet for all your credit card or payment window for everything, and you get a lot of hefty discounts and things like that, a lot of nice offers. Then some other examples are over here, which has basically got a huge amount of Series A funds, the lowest one is like $20 million. So, you can think about the amount of funds which are disbursed, right. Okay. Further, speaking about the Series B, C, D, E, F, G, H and beyond, there are a lot of these series of funds, right. The common funding sources utilized by startups in these stages are typically venture capitalist funds, right. So, VC funds with larger ticket sizes in their investment thesis provides funding for late stage startups. So, some of the VCs are with the opinion that we want to only invest in startups which have operated for 5 years, which have revenue of at least this much, which have a profit margin of this much, which has been able to consistently grow at a CAGR of this and this. Okay, so these are some criteria which some VCs clearly have, and based on that they can choose that they only fund, let us say, Series B and Series C. They are not looking at providing Series A funding, for example, right. So, even though the series or the stage of funding is different, the instruments or the categories which are providing these funds are still the same. They are the venture capitalist, just the amount of money which they are providing or putting at stake is bigger, right. So, they are typically looking at something which is some company or product which has generated a huge amount of market traction. Also, there are cases in which a pool of VCs may come together and fund a startup as well. Some form of this we have seen in Shark Tank, where 2 or 3 VCs are interested that I will give you 5% for this much amount of money which I will put in your company. The other person says I will give you 7% for this much amount of funds, and you want to take all this offers, right. So, sometimes a pool of VCs may take up like, let us say, 20% of your company total by 5 investors, and they are pulling in, let us say, 50 crore, right. So, these kind of things, this may sound to be very big and I am like still in the startup phase. So, let us start thinking in lakhs to start with. What do we need and to get our funds right, and then we can slowly think about crores. There are several products which would require you to raise funds in the amounts of crores, right, because of the equipments or the other avenues which you have, capital requirements and things like that. Then you have private equity or investment firms. These are generally do not fund startups, but however, lately some private equity or these kind of investment firms have been providing funds for fast growing late stage startups who have maintained a consistent growth. So, the keywords here are maintained consistent growth or which has a significant market traction. So, deviating from the initial seed funding to like pre-seed funding to, let us say, Series A and further, you are looking at startups which have established themselves over the years, right. So, most of the other categories of funds, it is good to know as an entrepreneur that what funds exist, but may not be applicable to majority of us who are trying to start a company for the first time. We are typically looking for pre-seed or stage A, right. So, having said that, let us take a quick look into the types of funding rounds for different startups. So, the stage focus is given here, the common elements of growth and the amount of investment, the ticket sizes are given here. Typically during the pre-seed stage, you are looking at the proof of concept or the prototype, right. And the common elements of growth is how the startup is going to grow. it is going to hire a lot of people, right? It will hire a lot of manpower who would contribute to the technicalities, sales and marketing, like to really go from one city to another, branch out and do things like that. So the amount of investment is typically in the order of $10,000 to like almost $1,000,000, so this is the typical amount of approximate investment which is looked at, like during the pre-seed funding stage. Then you have Series A, where the agenda is revenue growth, and you are looking at development of operations, branding and marketing. These are some areas in which the companies are trying to grow during the Series A. This is like 10 million and dollars and plus, and the definitions of these numbers may change. These are not the latest updated numbers. This may also have a different definition when we talk in terms of Indian rupees, right? So Series B is again growth phase. This is where the hiring, market expansion, buying businesses. So several of the companies, you will see, they are constantly acquiring smaller businesses who may be competitors, or there could be companies which they want to buy and quickly make them like sustainable and profitable. So I know of quite a few companies in the market, like the big ones, like like if Reliance or Adani, or the big ticket investors, they would want to do a lot of market acquisition into these smaller companies or startups. They're always looking for, they have a division looking for companies which they can invest in, and that is where Series B funding is typically useful, right? Then Series C is for large scale expansion, like acquiring businesses is one. You're trying to get into the international markets. So a lot of the startups, specifically in the healthcare segments, they may find that the dollar value of their product is much more higher, like their as compared to the Indian value what they are getting out of their products, because India is a very price sensitive market. So after spending, let's say 5 or 10 years in India, they feel like now they want to get out to the US market and get a bigger dollar value per product, right? So then they can look for something which is known as a Series C funding or further. Okay. Series D and further, this is usually the state of scaling. At this stage, the startup is experiencing a fast rate of market growth and increasing revenues. So everything is working well for this startup. This is typically where you would start chasing for Series D and E. Very few businesses choose to move to the Series D and E stages. This is good to know, right? What is Series D? This is finding a new means of expansion before angling for an IPO. So Series D is typically taken by companies where they're almost ready for an IPO, where they want to be public at a certain point, right? Series D is also used for companies who are willing to stay private for a little longer before they're making the switch towards an IPO. Businesses failing to meet its expectation from Series C. So sometimes Series D would be used or Series D would be sought after if after using the Series C funding, the businesses still did not grow to that stipulated levels where they thought it would grow to. Series E is basically fundraising round that acts very similarly to that as D. It is rare to see companies progress to Series E stage of investment, and the founders usually make the move to an unforeseen circumstance. So many a times there could be disputes, or there could be some calamity or some kind of national crisis which has caused the company like some shortage of materials and things like that, which has caused the company to not get to that growth level of actually thinking of becoming public or a bigger company just yet, and for these unforeseen circumstances they want to seek Series E, and many of these have been experienced during the pandemic, right? So companies are not able to self sustain, and the sales have really gone down and things like that, right? So on the right side, very clear. On the y axis we are looking at the amount of money which is typically invested, and this can some of the numbers which I have just shown you are all representative numbers, they are not the actual ones. and this may differ based on the currency, right. And on the x axis we are looking at the stage of investment. So from the concept research to business planning, product development, first commercial, fully commercial, to expansion and ready for IPO, you are looking and going all the way from the seed stage to angel investors to early stage to series A, B, C, and there are some mezzanine kind of like series like, and then you have which are typically the D and E, right. So these are the different series of funds which are raised during different timelines or timestamps of your startup. So these are all good to know. Series F, G, H and beyond. It's possible for your startup that to not quite see itself as prepared for an IPO or fully immersing itself into the market and subsequently choosing to engage in more rounds of funding. Many of the startups do not want to go for IPOs. Are the publicly listed companies all we have? Like probably it's a very small fraction of the total number of startups or companies which we have in India, right. So many of them are not choosing the IPO route, they don't want to dilute their stake and things like that, they're doing really well, right. So then they may look for FGH rounds of funding and just to keep them afloat, like so they're doing well and things like that for their business operations. So one example is in the wake of COVID-19 pandemic, more businesses have been entering the later stages of funding to ensure that they survive without having to suffer heavy losses due to the lack of productivity or consumer power. So we know about what happened during the pandemic, right? Like all these sales just completely got slashed, and many of the companies, including the healthcare companies, were not making sales except the ones which are selling masks and face shields and sanitizers, right? So these majority of the companies which are selling surgical instruments and things like that, and which are not very popular during such a calamity, are usually looking for raising more and more funds just to keep them running, like while their sales have diminished and things are not moving well, right. Another example is this mezzanine financing, which is typically a standard loan, equity fundraising or both together. It's a top up funding option for big projects. For instance, if you were aiming to raise upwards of $10 million and you agreed a loan of 7.5 million with a standard lender, right. So sometimes you are looking at stopgap arrangements to make sure that you had a little bit of top up requirement and which you are kind of taking care through a loan, either a debt financing or equity financing, right. So mezzanine is typically when you would not jump to an equity financing typically because you don't want your stakes to dilute any further, but you would rather raise some funds to get you going, right. So the final stage is scaling, where the startup is experiencing a fast rate of market growth and increasing revenues. This is a story in which Zomato, which all of us know very well, this is the fundraising story of Zomato. Just this is all public information. So from 2013 to 2020, they raised 2013 they raised around these are in millions, this is what you're looking at, millions of dollars, $37 million from InfoEdge, which is their parent, one of the key investors, key investing companies, Sequoia Capital. Then they again raised $60 million from InfoEdge, $50 million in April 2015, then $60 million again. Finally, a huge amount, $660 million from Tiger Global, Ant Group, Luxor Fidelity, FMR. These are the big players in the market. So you can see these are all kinds of angel investors or the VCs from which the funds are raised by the same company for a good bit of 7 years, right, like you're seeing. And I'm sure they've raised quite a bit of funds later on, even before the IPO. So that was one of the example of the different stages of fundraising. So it's not that you would raise funds only once in your lifetime or twice, it could be in several different stages, right. Another example is Urban Company, which a lot of us can relate to. This is Urban Clap or Urban Company, which we all know of. So this provides all the home based services and other kinds of services which are at your disposal. So here Urban Company from March 2015 to April 2021 has been engaged in Series A funding twice from three different companies or more, Series B funding, some debt financing, Series C, Series D, Series E funding, and these are some of the amounts here up till $188 million, starting from $2 million to $188 million, and the valuation accordingly of the company of course shoots up, because this also is incorporated the fund raising amount. This is also the sources given here, right. This is another example whereas very popular company has engaged itself in several stages of funding, right. Another example is the Ola success story, where how Ola became India's leading cab aggregator, where 2010 this Ola Cabs was founded, and then 2011 this raised around $500,000 in angel investment from like some of the big investors. 2012 $5 million from Tiger Global Management. 2013 $20 million. Ola became a unicorn after raising $900 million from different investors. So, unicorn becoming a unicorn does not always mean that you are excessively doing well as a company. Yeah, of course they were really doing well, but along with that the amount of fund raised sometimes will give you a unicorn kind of status, right. So, overall how you are doing and the amount of fund raised has a huge implication on your company as a whole. So, if you look at the further journey of Ola, like 2020 they have raised around $250 million from SoftBank for Ola Electric and expanded its cab services in London, right. So, these are the different series or steps of funding which some of the very common well known companies have taken. Then there is another one which is the exit option, which I have talked about. At this stage is the startup is experiencing a fast rate of market growth and increasing revenues, and they probably want to exit out of this, right. This can happen in terms of mergers and acquisitions. So, the investor may decide to sell the portfolio company to another company in the market. In a sense, it entails one company combining with another, either by acquiring it or by being acquired. So, many a times you want to your market valuation of your company is, let us say 500 crore, and you want to sell this out to some other company and probably go for some other ventures or entrepreneurial ventures or something of your own, right. So, you can look for mergers and acquisitions for that exit option. You can also be looking at initial public offering, which is the IPO, which refers to the event where a startup lists on the stock market for the very first time. Since the public listing process is elaborate and replete with statutory formalities, it is generally undertaken by startups with an impressive track record of profits who are growing at a very steady pace. So, you would typically not see startups just like a few years down the line you would think about an IPO. So, that is typically not the case, right. So, there was a company I was following recently, it's a company in the AI space. This is known as like Selfmog Design and Tech. This has created done an IPO within just a 3 to 4 years mark. This was doing increasingly well, like with this company financials and other aspects. So, they launched an IPO quite early. So, there are so many other companies out there in the market which can do an IPO in 5 or 6 years or maybe earlier, but it depends. As your startup grows, you have to look at consistent profits and market visibility, right. Selling of shares, investors may sell their equity or shares to another venture capital or private equity firms. So, there are cases in which somebody is ready to pay, like let us say 50 crore for your company, and you feel like what you really intended out of your company initial was 20 crore in 10 years, and you are getting this 50 crore in 5 years. So, you are ready to now sell 95% of the shares in this company to this VC and just retain 5% for, let us say 45 crores and just walk away with it, right. So, things like that are sometimes done by selling of shares as an exit option. Buybacks, founders of the startup may also buy back their shares from the fund investors if they have to liquidate assets to make the purchase and wish to regain control of their company. So, sometimes you have diluted or given out too many shares to the VCs and other people, and you want to buy back some shares to regain further control of your company. These are some healthy indicators of a company's lifetime, right. So, many of these terms I will not get too much in depth with, like if you look up these terms you will understand what they are on Google. but this is just to give you an overview of some of the options which are there for a startup as it goes through the different stages of the fundraising cycle. So, the next part is, what do investors look for in a startup? What are the investors actually looking inside a startup? So, they are first of all looking for into the objective and problem solving, whether the offering of a startup should differentiate itself to solve a very unique customer problem or to meet specific customer needs. Ideas or products that are patented shows high growth potential for investors. So, if you have secured a patent for your product, typically this shows your seriousness for your product, and maybe this is very, very unique. Otherwise, you would not get a patent at the first place, right? So, sometimes having a patent, there could be questions of whether I need a patent or not. You may not actually need a patent, but like if you can have a patent on your product, sometimes when you are going to seek a fund from a VC or angel investor or wherever, you know, it gives a much more bigger weightage that this company has a patent and this is really interested in raising funds, right? Next is the management and team. The passion, experience and skills of the founders as well as the management team to drive the company forward are equally crucial in addition to all the factors mentioned above. Do you have some very experienced team members in your team? So, let us say it is very common for majority of the startups to start with 3 or 4 friends, and like none of them have a lot of experience. So, typically when you go to seek funds from a VC, they will deny you funding. So, sometimes it is good to get some people on board who are really experienced in certain sectors. Maybe they are very good in sales and marketing. Sometimes you would like to get somebody who has a 10 years experience in working with some really good high quality startups, join your team for a little bit better salary or some other incentive like equity or whatever. So, sometimes you would want to involve mentors, right? Maybe your healthcare startup wants to do certain things and you want to involve, let us say, one of the IITs. So, you can reach out to some of the professors or people as mentors, or some really well doing, like medical device company where you would like somebody from higher up in the management there to serve as your mentor of your company. So, now when a VC or a funder is looking at the management team, they know there are some experienced people in the team. Now they are very much willing to fund your product. Otherwise, if they look at a bunch of amateur, like founders like who are just there, they may not be very willing to put down some funding for these amateur players, right? Next is market landscape. So, the market size, obtainable market share, product adoption rate, historical and forecasted market growth rates, macroeconomic drivers for the market, your plans to target. So, many of the sales forecast, how much return on investment or how much money can you actually make, these are actually crucial factors for a funder to look at your particular product. So far if you look at it, they have not looked at your technology. They want to look at how much return of investment can you really provide them. Is your product having some nice people in the team? Are your objectives very clear, right? Scalability and sustainability. Startups should showcase the potential to scale in the near future along with a sustainable and stable business plan. So, you need to have a business proposal or a product proposal there at the end of your final, before you commercialize or before you are ready for fundraising, to really place that in front of everybody and try to get a very holistic feedback and the right funds which will be willing to fund you, right? So, they should also consider barriers to entry, imitation cost, growth rate and expansion plans. Sometimes you want to look at barriers to entry, what amount of funds do I require to make sure nobody else can access a product similar to it. One barrier to entry could be filing for a patent, that way nobody can steal your idea, right? What are my expansion plans? Do I want to very aggressively expand in 5 states, or do I want to expand in 5 years after gaining some experience? So, these things are all important factors for a funding agency or a funding body to basically discuss and understand whether they want to fund you or not, right? Customers and suppliers, clear identification of your buyers and suppliers. They want to be very clear that you know your customers very well, who your target customers are, right? All this information is going to basically come through your customer discovery. So, only if we do all these steps which we have learned in this course with due diligence will we be able to make a very balanced business plan which can stand out in the market, right, while we are trying to raise funds. So, one is like identification of the buyers and suppliers, second is stickiness of your product, vendor terms as well as existing vendors. Are there people already buying your products or willing to buy your products? Do you have some testimonials? So, all these things become very, very important. Competitive analysis. Have you done a clear competitive analysis on where your product stands with respect to your competitors? If you have not done it, then also you are going to fail, like while you are trying to seek funding, or if you have done a poor competitive analysis, then also there is a high chance of failure. So, a very detailed and comprehensive competitive analysis is very, very important. Sales and marketing. No matter how good your product or service may be, if it does not find any end user, it is of no good. This is the point I was trying to emphasize since the day one of this course, is doesn't matter how good technically your product is. If it cannot find a customer or an end user who is going to pay for your product or service, it is of no use. In the entrepreneurial world, it is a failure, right. So, these investors also want to look at something similar, that do you have a range of customers who have said really great things about your product and who are willing to buy this, right. Where is your customer discovery summary? These kind of things can be asked about, right. Financial assessment, a detailed financial business model that showcases cash inflows over the years, investments, required milestones, break even points and growth rates. Do you have a clear financial plan in place? So, something where it is a financial projection, when you are going to reach break even and things like that. Do you have those things in place? If those things are not there displayed on a slide, they may think this company is not very well planned and just drop your idea, right. Exit avenues. Has the company thought about exit avenues? Have they thought about what if after 3 years they have either made a lot of money or they have not made too much money? What are the exit avenues where the investors as a whole are not going to lose out on a lot? Because at the end of the day, the investors do not want to throw in money into something where it is just a waste of their money, right. So, we have to all align our thinkings towards the investors, what they can think about while building our product proposal or the business model, right. So, here is an example like where you are looking at a startup, like where there this person the very top, this is just written as abroad because this is an example from abroad, where this person is like trying to explain a startup idea with a business proposal, and there are this lot of folks who are sitting there, they are from an investing agency and they are trying to record and kind of discuss among themselves whether they think that this idea or this technology is good and whether they want to fund it, right. And here is an example from India where this is a venture capital or angel investor fund, where these set of people who are very experienced, as you can see from their images, are going to look at your business proposals or like particularly the business model canvas and other details like of a company and decide whether they want to shell out funding. So, fundraising through grants, this is not the latest kind of updated, but you can look at startuptalkie.com. This is /list of government initiatives for startups. This is the source. These are some of the government grant schemes, and I am sure many of this the additions have happened, additions or subtractions. These are some of these grant schemes which you can look at, where you can apply for certain seed funds or grants where you do not have to worry about diluting your stake or things like that, where this can secure you some money to get you started, right. Then there is this Startup India. This is this very nice initiative by the government of India. Here you will find majority of the information which I have discussed. Okay. There is the Startup India seed fund scheme where financial assistance to startups are given for proof of concept, prototype development, product trials, market entry and commercialization. Yeah, these are extremely choosy because there are just so many startup ideas and companies which are trying to establish, right. So, this is one of the schemes you can look at. This is a excerpt from the Science and Engineering Research Board, which is known as SERB. It's one of the bodies for the DST. So these are some of the schemes and programs and awards and fellowships. If you look at here, there is something known as Startup Research Grant, like SRG. This is typically given to professors, these are usually institute faculties, and several of these funds may have an industry partner or your company as a partner. So you could sometimes work with professors and institute faculties to work to seek a certain amount of grant to get your prototype development and other things done, right. So these are some funding grants through the Government of India. This is another very popular grant scheme specifically for the healthcare sector, which is known as the Biotechnology Ignition Grant Scheme. This is known as BIG. This is usually popular through the grant scheme which is known as BIRAC. It's a part of DBT, I believe, and this is BIRAC is basically where you get this big grant where all healthcare based startups and companies can apply. This can get you funds up to 50 lakhs close to, right, and with this 50 lakhs this is typically given for prototype development and for setting up your startups. So as written here, BIG is the flagship program of BIRAC, which provides the right admixture of fuel and support to young startups and entrepreneurial individuals. BIG is the largest early stage biotech funding program in India. This is something which all of you should explore. I have known several companies who have gotten funded by the BIG grant, right. Funding grant up to INR 5 million, which is basically 50 lakhs to close to USD 70,000 to best in class innovative ideas to build refine idea into proof of concept. Again, very competitive, right. If you take a look out, they have their announcements quite a few times in India, like like on their website, so you can look out for their announcements and see when they are kind of advertised, and within a deadline you have to submit the grant. You typically need a registered company for doing this, so not at an ideation stage, like you need some company association in order to apply for a big grant, and sometimes you can apply it through academics channel as well, like if you are associating with a professor or faculty, right. Okay, the next interesting part is a crowdfunding platform. These are the top 2 crowdfunding platforms around the globe. The first one is known as Indiegogo, right, and the second one is known as Kickstarter. So I would just give this homework to all of you, just look up Kickstarter and Indiegogo. You would be really excited to see what kind of products they offer. There is a nice 2 or 3 minutes video which these early startup companies come up with, nice professional looking videos and with a set of like details, like very similar to the business proposal which I was talking, which what we have learned through the course, and I am going to explain business proposal in the upcoming lectures, exactly how this is to be arranged. So this is a nice business proposal. Also people start buying your products from these kind of like platforms. So these are all your early adopters. You can earn or raise a huge amount of funding. So I have seen companies who have raised millions of dollars of funding through Kickstarter and Indiegogo kind of platforms, right. So these are typically non-profits, non-traditional projects, flexible funding, everything else, like kind of, so Kickstarter is for everything else, right. So with this crowdfunding platform, this is an example. I had been taking this example of OneSource, our products. This funding was not successful, but this is still a good idea to share this with you. So we termed this as OneSource the ultimate customizable insole, and we were just at a stage where we had a company and we wanted to sell this for like $29 a pair, and this OneSource insoles have shown quite a bit, but just look at this. You are looking at 137 backers who had basically put in $4,000 US dollars, right. So somehow it was not successful because my goal was a little higher, right. So I was looking to raise $10,000 of funds for different operations and other practices which I am doing for my company. But the exciting part here is 137 backers were still there, right. Probably I would have like put it right. So if you set the limits right, you can get funds over that, right. So, if I would have set my limits to, let us say, $2,500 or $3,000, my funding would have been successful. I would have received all the funds, and everything, all these, then I have to just give the product, like the initial set of products, to this 137 or more people, right. So, this will be all for today's session. We are going to pick it up from exactly where we left today in the next session. So, see you all. Thank you.